Thank you very much, Greta. Hello out there. My name is Stefan Kolmar, and I would like to talk with you about a demo we developed showcasing how to prevent fraud using Neo4j as the foundation. A huge issue exists out there with retail banking called first-party fraud. Why? Because fraudsters are opening many lines of credit with no intention paying them back later on. The impact is high. In the US, tens of billions of dollars are lost every year. Consumer credits need to be charged off as a result. And this is just the tip of the iceberg. Banks in the US and in Europe often classify first-party fraud as unsecured bad debt, causing then, of course, economical and financial impacts. There are various and different scenarios on fraud. The first ones are fraud rings. Fraudsters are generating out of existing valid addresses and social security numbers artificial and synthetic identities, which are in the combination together not valid. Suspicious e-commerce. Purchases are done by synthetic identities using the same IP address, shipping goods to the same address while ordered through multiple different accounts. Duplicate user phone numbers. Orders are done by these synthetic identities using the same phone number, shipping to the same address. And skimming. Information on a credit card is copied and then used within a time frame in different locations where it is impossible to physically pass over a credit card. Note, in some of these scenarios, it can very well be that there is no fraud. As an example, if multiple members of a household, such as a father and his daughter, are using the same computer and the same phone line, it might very well be that a valid transaction to ship goods later on to the same address. But the more you take advantage of the connectedness of your data involved in a transaction, and you use and value the information provided, the more you can see if there is an attempt to commit fraud or not. You can then, with the information available, refine your algorithms and learn from the past scenarios defining fraud cases. Based on these 4 scenarios just showed, we have built a demo. The foundation is a graph database containing retail customer information connected to a fraud application. An analyst at a retail bank, an insurance, or an e-commerce retailer would use this application as the dashboard. An application as part of the demo is injecting fraud cases, and as soon as a pattern for the 4 fraud cases is detected, alerts are generated. As a second step, these fraud cases detected could be exported for further analysis. An easy example would be to export the data into Excel sheets. Now let's look into the demo. What you see here is the dashboard, and it's a dashboard a manager investigating fraud would see as his home screen. What you see on the top line here are potential fraud cases. Potential fraud cases which have been already detected by the algorithms and which have already occurred. If you click now, as an example, on the fraud rings, you see more details on the cases just observed. Let's click on one fraud ring, right? If we pick one fraud ring, I mean, what we see here is a ring size of 2. So it's a party of 2, the fraud ring, and the financial risk associated, which is basically US dollars. So if we click on this, what we see here is a fraud ring, and what we really see here is if we go on these buttons, like here, we would see individuals, right? And these individuals, like first name, last name, you see on the right hand side, they both connect to the same address here, right? And that is an indication that something might be wrong. If we take another example, I'll show you just in a second why we take another example now. In this example, I was looking for that one because in this example you see that 2 individuals, Audrey and Audrea, right? They are sharing the same social security number, which is of course something which is at least suspicious, right? Because a social security number by definition should be could not be shared between individuals, right? And what you also see here then, so that's this relationship. You see here it has social security number. That's a social security number. And here you also see this person here pointing to the same social security number. You also see that they share the same phone number. And they have multiple relationships. So as an example, Audrey here has a bank account. You see on the right-hand side that this has a balance, has a credit card with a limit of 75,000 in this example. There's the address, and here is an unsecured loan, also with a balance of 5,661. Right. So in a sense, what you can do with all the information is, first of all, you detect, hey, here is a potential problem. They share the same social security number. That's one thing. But further on, you can also calculate the financial risk associated. Right. The reason why I switched from the first one to this one is because, of course, sharing an address is something which might be not that suspicious, because, of course, people are sharing addresses if they live in the same household and so on and so on. But sharing a social security number, that's what I was looking for in this case. That is, of course, something which might be really suspicious. Right. So if we look then at bigger fraud rings with a ring size of 3 members, we see basically these 3 members all sharing something in common. So they have in common basically also the social security number. They have in common the same phone number. These 3 individuals, 1, 2, 3, right? And you can also calculate here the financial risk associated. So far for the fraud rings. So if we now go as a second example into the suspicious phone transactions, what we see here is a phone number, a particular phone number, and also financial risk associated to it. Right. So here is the phone number, and we see also here that 2 individuals, Abby in this case, and also Abby. I mean, these are generated names, so they by definition look familiar, right? But anyway, I mean, they are both pointing to the same phone number, and they have done money transfers, right? They have unsecured loans, they have credit cards, and so on and so on. So that might be also something which is at least worth to further investigate, to look into the data and find out if something is suspicious here. But here you also see that both of these individuals, they share the same social security number, again, which is, let's call it, uncommon. Right? As a third use case, as said before, this would be suspicious e-commerce. So we see here as an example a shop. Let's take this one, right? In this shop, we see that 4 purchases have been done. So this is basically the IP address where all the purchases have been done. We see two logins, right? And we see all in all 4 purchases, right? Done by multiple credit cards. So that's a bank card, that's a bank card, that's one, right? And these are various logins, right? So why is it suspicious? It is suspicious because they have all used here the same IP address to do the purchases, which might be also something you may want to check out if this is valid or not. Could be okay, could be a reason to further check. Skimming, I think, is the one which is most suspicious also, which in this case, let's take as an example this one, where the account number, which is a credit card number, has been used in 2 states, here in New York and in Oregon. So if we click on this one, we see the yellowish, right, bubble. Here is the bank card, the credit card, which has a limit of 10,000 on the right-hand side, as you see. And then you see that two purchases have been done, the red ones, right? And this was done by an IP address, which actually is located in Oregon. And this purchase has been done with an IP address originated in New York, right? So I will, if you're interested, I will, and you stay on, right? I will show you later on the cipher query on it, or the query which is running against it. In short, what has been done there, what has been implemented there, is actually to verify a time span, so that it might be impossible, right, to physically move the credit card over from Oregon to New York, because if that would be a time span of, let's say, a day or so, or 14 hours, it could very well be that this works. But if the time span is, let's say, an hour or so, it's more than unlikely that the credit card physically has made it from Oregon to New York. So far for the demo. Now let me go back into the presentation. So again, I mean, probably I go back once more to the demo here. So if you see the home screen, one thing I haven't mentioned in the beginning is also an overview here. So you would see here also as an overview the financial risk per ring size. So blue would be ring sizes, fraud ring sizes with two members sharing one thing in common. Let's say a social security number. Red would be 3. Ring size of 3, yellow 4, green and 5. So that would also be kind of an overview for an analyst to say, hey, I see my financial risk per ring size might be biggest than in the green one, right? If you have 5 parties pointing to the same social security number, that is the biggest, and so on and so on. So this is kind of a dashboard. This would be kind of an application. Typically, a typical analyst would work out of every day. So the question you might have now is, so help me out. Could this also be done with traditional relational databases, or what is the good thing in Neo with doing that? Well, judge yourself. With Neo as a native graph implementation and inherited flexibility, we can deliver very successful projects using the agile development approach, where you don't need to define in comparison in a waterfall planning mode long-running projects, and you only see towards the end of the project if this fulfills the needs. With agile development approaches used with Neo, we use sprints to validate the approach with within each of the first 2 weeks, get the low-hanging fruits first, iteratively extend the prototype to a framework, and reach high productivity throughout the full process, sprint after sprint. That is really something which is spot on for Neo, right, and which might be very hard to do with other approaches like relational databases. This is also about taking advantage of the full value of connected data. You can use all the hidden value provided in your data to your advantage. Traversing a graph is, compared to joins in a relational database, especially if you need to use self-joins, extremely efficient and consumes very low computing cycles. Of course, you also need the high performance Neo provides to prevent fraud. Every millisecond counts, so detecting fraud after the fact is only the second best solution. Neo can help you to prevent fraud before it even exists by using the performance to detect suspicious patterns, as you have just seen in the connected data graph database can provide. The last point, to be schema-free, also allows you to be extremely flexible, storing and interpreting the data as you want it, and not as your relational database management system forces you to do. All kinds of nodes can have a relationship with each other in a graph. No schema definition is required beforehand. And furthermore, there is no need to find a common denominator before you can load and access your data. So how does this then fit into your big picture? If you take this simple demo and put it into the context of your existing architecture, you can protect your investment, integrate Neo as part of your infrastructure, and close the feedback loop. Operational data out of an ERP system, as an example, are constantly feeding information of the business transaction into the graph database. So that's the scenario you just saw. What we want to achieve now is to take the suspicious data out of the graph database and enrich this with internal and external data using data integration technologies. Internal data could be coming from existing CRM systems, like financial systems and others. External data could be accessing public data, such as credit risks, further enriched with geographic data showing income or debt risks. The extended data will then be provided to a management console, which could be built on top of BI tools used. A fraud analyst can take manual actions, or even machine-generated actions could be triggered, such as canceling the transaction or even canceling the credit card. To close the loop, then, this data could flow back into the CRM system and finally into the graph database, where it can be used investigating further potential fraud. So what I try to do here on the slide is basically show that Neo can be the foundation of a fraud solution and can trigger and can feed into all kinds of applications on top, so that in the end you have a big picture and you can protect your investment further on. Now let's look how to set up the data transformation tool in the scenario just described to achieve what we just discussed. Here is the full data set we want to use in the analysis tool. This would consist of the identifiers of the members of the fraud ring information we found in the Neo demo before. It could be enriched then with information from the CRM system, and last but not least by geolocation information. So this is the enriched information. So this would be the resulting information we intend to bring together, combining various sources. In this tree structure here, you see the identifiers coming from the demo system as detecting the fraud cases, combining them with data from a marketing or CRM system, and external information from, in this case, Google geocoding. So this would be the fraud from the Neo system, this would be the marketing data or CRM data, and this would be geocoding data. So let's now define the data source where we get the fraud incidents from. This is our REST API from Neo, and from the demo database you have seen before with a simple query. You see now to access the information from the fraud incident. So here's the REST API, and here's the simple query to access the data. Now here we execute the data, executing the command, receiving the data. Waiting a second, and now we have all the information combined from the three sources. Actually, the demo enriched with specific information on the accounts, as you see here, and then the geocode information. Here's the execution tree highlighting where the raw data was coming from. So here the Neo data. Here they're pointing to the REST endpoint. That would be the information from the CRM marketing system. It would be a simple MySQL database in this case, from a JDBC source. And last but not least, accessing the geocode information. Ending, as said, in the combined view. And here you see the combined view where you have all the information together. When we go now one step further and switch into the analytical interface of a BI tool, what we need to do, of course, we open the data source we just put together. So that would be pointing to the integration tool and to the data source from there. Connect this. We select the schema, and a table from the transformation as before. So the table name would be marketing data containing. And now we get our fraudster information. Dragging the fraudster information into the template, processing the request, and getting all the information together. And now, as a next step, we can define a template as an example to correlate the job information with potential fraud attempts. So we take the job codes, and we take the records found in the fraud demo. And as a next step here, we would show basically the various job codes and how many fraud cases are detected. As just an arbitrary example here, we would see an automation specialist and four fraud cases, 4 fraud attempts being made. Now, if we go one step further, as a next step, we would use the geo information for visual representation of the data and showing this in a map. So also here, taking the records, the states, processing, and as a result now you see the distribution over the United States of this in the various states itself. And if we now go to a graphical representation, we will see the fraud attempts mapped over the US. So far, so good. A couple of conclusions. Connected data, as you can manage them in a graph database, provides you the full value detecting fraudulent behavior. You can use Neo4j to build the foundation for your solution to get a 360-degree view on potential fraudsters by integrating all the information in a consolidated view. And Neo can be used in your existing environment, protecting your investments already done. Due to its openness and usage of standards and standard interfaces, this fits very well in any given enterprise architecture. Actually, at this point in time now, I would be already at the end of the presentation. But I thought I have one more thing. If you bear with me and you want to get a bit deeper, let's look for a second into the Neo database using our browser. For that. Let's get rid of that first. So, in case you're not familiar with Neo, the browser is best described as a tool to validate the concept and browse the data first. Right? So what you basically see here are the node labels, or the labels we just saw. So as an example, we saw the social security numbers, we saw then also the account holders, we saw the credit cards, the addresses used, we saw the relationship types, so it has social security number as an example, and if we click on that, you see basically all the relationships between account holders and social security numbers. So if we now use a first very simple cipher query, we can use this cipher query just to simply find social security numbers. So what I'm saying here is give me basically all account holders with that, which has social security number. It's actually the same thing as here, basically, but I want to see the account holders and I want the social security numbers limited by 10. So if I do that and I go to another view, here seeing the rows and seeing the tabular view, I see here basically all the account holders and the social security numbers related. That might be useful information, right? But it's even more useful in the context of detecting fraud. If you ask yourself, hey, I mean, good to see the account holders, but I want to see basically account holders sharing social security numbers, potential misuse, as said, right? So this is basically then a cipher query where we are looking. Basically, an account holder has a social security number. We hold the social security number here, and then we ask, hey, is there a second one? Is there another account holder pointing to the same social security number? And then display them. And with that, basically, we get individuals, account holders, who all point to the same social security number, like this one here, right? One of the highlights, I think, using a graph database, at least to me, is always using shortest path algorithm, whereby you use two potential arbitrary points in the graph, and the algorithm searches if a path exists between them. So let's say, as an example, this one. Let's say I want to see if a relationship exists between an account holder with the first name of Abby, and then there's another account holder with the first name of Abel, right? So what I want to see, is there any path with a length of maximum 5 connecting these two account holders? So if I fire this query, what I see basically is, yes, that such a graph, that such a connection exists, right? And the connection between these two individuals would basically go via their address. So these actually it's 3 account holders. So these 2 account holders, they both share the same address. And then this account holder basically shares a phone number with this account holder. And what I wanted to find out is, how are these 2 individuals here, how are they connected? In a real-world case, what you would want to do, as an example, detecting insider trades in a bank, as an example, you could very well ask, hey, I mean, are these 2 people related? And if yes, how are they related, right? And that could be a good value of using the shortest path. If you simply have 2 specific account holders and you ask, where's the connection between these 2? If we now look into the cipher query you just saw in the demo, here is basically one cipher query which was used before detecting the fraud rings. So this is the cipher query where we detected the fraud rings. Basically, as a step number 1, here we find, are there shared contact information which are basically more than 1. So do they share something, which might be a social security number, might be an address, might be something else. And then we take this, we gather this data, and then basically we find all the information that's around it. So if we run this, then we see that we have detected, with this cipher query, we have detected in our data a ring size of 3. A fraud ring with these 3 account numbers, basically with a financial risk, and the contact type they have in common would be an address. Here the contact type would be a social security number and a phone number, and so on and so on. This query can be also then formulated more in a browser-friendly way, so that you see more in a browser than the connection of the data. That would be the result. And if you remember the fraud demo, that's quite similar, right? And this has similarities. With that, I'm basically at the end of this presentation and this demo, and I would like to hand back to Greta and open it up for questions, if I may.
Okay.